Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, last week we talked about the effect to earnings with taxes and net overhead. But it's been a year and I still feel that banks need to concentrate on their net interest income in overall dollars. So when we look at that on an overall basis, FTE, fully taxable equivalent, in terms of those dollars, how does your bank compare to last year at this time? Is it a lower number or is it higher? We want to see that staying either the same or growing on an overall basis. And I think that this is key. A lot of people focusing on the net interest margin. But the point is that even if the net interest margin is declining and those net interest income dollars, FTE, are rising, that's still a positive situation in here. So strategically, banks are focusing on the fact that most likely interest rates will stay low for the next year. And within that, once again, we have to concentrate strategically on the things that are going to continue profitability at a higher and higher level. Because we're hearing more and more banks getting nervous, seeing their earnings somewhat declining. And the thing is to basically lay out scenarios, do models in terms of what you should do to prevent those earnings from slipping in here. One of the things to consider is really understanding the duration of your balance sheet and looking at it from the standpoint that if we feel that rates remain low for 1 year, can a slight increase in duration overall in your balance sheet with the way that the yield curve is set will add more and more earnings to your bottom line. But once again, you have to look at that as a risk and what amount can you do in order to increase those earnings or at least try to maintain them. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.